Welcome. My name is Michael Kiley. I'm the founder and CEO of PAI. PAI is a national third-party administrator and record keeper for 401k plans. Today we're going to talk about the game changer that is the DOL Fiduciary standard that recently came into the industry. Specifically, we're not going to talk about the details of the fiduciary rule. We're not going to make you an expert. We're in fact going to give you some solutions for being successful in the environment of the new fiduciary rule. A little bit about PAI. For more than 30 years, PAI has helped small businesses and the brands who serve them provide retirement success for their workers. Today we serve over 13,000 employers, 200,000 employee plan participants with $4 billion in assets under administration, and approximately 7,000 financial advisors, a number that may be changing in the days to come. PAI brings turnkey participant outcome solutions to small businesses and their employees nationwide. Our company and our service are based on 3 simple value verbs: care about our customers, know how to serve them, and do what it takes. For myself, I've had the honor of being in this industry for 33 years. I've been involved with the Council of Independent 401k Record Keepers, the Women's Institute for Secure Retirement Advisory Committee, the United States Chamber of Commerce Employee Benefits Committee, and the National Association of Business Economists. The industry has changed constantly in the 33 years that I've been involved in it. This new fiduciary rule is significant, and it represents about the 6th significant chapter change for PAI and the customers that we serve. Before we continue, I have to give you the mandatory disclaimer. PAI is a record keeper and third-party administrator for workplace savings plans, including 401k plans. PAI is not a registered investment advisor and is not licensed to provide investment advice. Nothing contained in this presentation is to be interpreted as legal, financial, tax, investment, or accounting advice. Please seek the assistance of professionals for your specific needs. What's in it for you? What we won't be doing today is we will not make you an expert in the DOL fiduciary rule. What we will do today is make you an expert at living with the DOL fiduciary rule, and we'll give you a profitable customer solution for continuing to serve your customers and grow your practice. Our agenda for today, we will go over some DOL fiduciary rule facts and timeline. We'll talk about what's the risk, really. There is only one ERISA, and the E stands for employee. Adding value reduces risks. CoPilot retirement service, our solution for the new DOL rule, and how to take action for fun and profit. The DOL fiduciary rule facts and timeline. The DOL fiduciary rule has been in the works for quite some time. It's made up of 2 parts. The conflict of interest rule, which changes the definition of fiduciary to encompass the actions that savers and sponsors have always thought were being done in their best interest. The applicability date of the conflict of interest rule is April of 2017. And in addition, the second part is the best interest contract exemption. Best interest contract exemption is a prohibited transaction exemption that allows for the continuation of many well-established compensation arrangements with some limitations, provided that the fiduciary advice that results from the arrangements are made with undivided loyalty to the recipient, prudent, and the compensation is reasonable. The applicability date of the best interest contract exemption is January of 2018. So what's all the fuss? The fact of the matter is, it's easy enough to stay out of trouble with the investments in a retirement plan. If you keep costs reasonable, keep products at arm's length, in other words, don't sell anything that you manufacture unless it's something that's publicly registered, have a process for keeping those investments up to date, and work that process, don't ignore that process, it seems simple enough. You can stay out of trouble on the investment side. So we may be thinking, we dodged that bullet, except that bullet keeps going until it finds a target. The real problem with the environment of the new DOL fiduciary standard is that the DOL is looking at ERISA as the Employee Retirement Income Security Act. And everyone who's a fiduciary has a role in that equation. And you typically are the one closest to the participant and their retirement income security balance. The fact of the matter is you can have great investments and investment processes and still have participants arrive at retirement in bad shape, unprepared financially. The DOL isn't the challenge for you. With this new rule, you need to worry about the target that the DOL put on your back for the lawyers and the courts. That's what your home office is worried about, and should be. We'll go through that in specifics. Most of what you hear about fiduciary solutions comes with the tag 338. 338 is a reference to a level of investment service that can be provided to retirement plans that is designed to be specific and follow some rules. Unfortunately, we have a 338 that we've been working with for actually a little over 10 years, who last year had an unfortunate participant level claim. The plan in this context was set up very well. Had a 338 contract, had 5 target risk portfolios that were market leading. There's plenty of general web and electronic educational material available. And unfortunately, the participant placed themselves in an investment position which was clearly not in their best interest. Unfortunately, they successfully argued that no one was paying attention to them, and that individual participant did not receive the service for the BIPS rate that was paid for the financial advisory service under the 338. The result was an out-of-court settlement. The 338 involved ended up returning all of the fees on the entire plan for a period of 5 years, and that 338 narrowly avoided buying the market for that participant. 338 is a beginning. It's a good place to start in the structure of a service of a participant. However, from the Department of Labor's point of view and from the courts that'll be battling these types of things out, what they're really looking for is participant outcomes. How much should I have? What should I be doing now that I'm willing and know how to do? And why won't I have enough money for retirement? Unfortunately, the answers that they may be looking to find is, you charge me too much, or I was in the wrong fund, or I didn't contribute enough, and worse, and you don't have the conversations or the evidence that prove that you told me so. The facts of life with retirement preparedness are that participants don't intend to arrive at retirement without enough money, but they do, regularly, and very often you're their retirement guy. In 33 years of retirement service, I've never handed a check, big or small, to a participant who said, "Wow, I shouldn't have saved so much. I wish I had spent more." So from the DOL's perspective, let's talk about what the fiduciary lane looks like. True fiduciary service to a participant means making sure that the participant establishes a retirement goal. It's not enough that that participant can state an amount of contribution that they're willing to make. You need to be able to establish for them some semblance of what that contribution will buy for them in retirement readiness. You also need to be able to establish that you have demonstrated to that participant how much money they should have. So even if they are able to contribute a certain amount, if that certain amount doesn't get them to an adequately funded retirement, you want to be able to document that you've informed them of that. That's the first challenge. It isn't a matter of sitting and describing a set of mutual funds or a target date fund or something of that nature and allowing them to start placing contributions into those funds. You need to talk about the retirement outcome. If you look at the orange jagged line in the illustration on the slide, most people look at that and think of that participant journey as the ups and downs of Wall Street, the ups and downs of the market. In fact, that orange line represents the decisions that participants make throughout their retirement journey. Some decisions make retirement better. Some decisions make retirement worse. The decisions that make retirement better are very simple. Number 1, join the plan and start making contributions. Number 2, increase contributions as time goes on. Number 3, make the right Social Security election, the one you can afford. Some decisions make retirement worse. Reducing or stopping contributions. Taking a hardship withdrawal, taking money out of the plan. Or making the wrong Social Security election. This is the picture of the fiduciary impact that determines whether a participant has an adequately funded retirement or an inadequately funded retirement. Doing the simple things to keep the investments working correctly alongside of this picture is just one part of the picture. We need to be actively engaged and be able to demonstrate that we've taken the participant on their retirement journey and provided them the knowledge and the tools to be successful. The fact of the matter is, there is only one ERISA, and the E stands for employee. The Employee Retirement Income Security Act does not have one set of rules for big employers and one set of rules for small. E means each or every, not average. In the industry to date, unfortunately, the A has tended to mean avoid accountability. If you want to reduce risk for yourself, your firm, your plan sponsor, and your participants, we need the A to represent add value. Provide them with education. Retirement success is about time, not money. It's time and how you use it. Your time, whether you have 10 plan participants or 10,000, you don't have the time to review each of their actions every day to react to bad decisions or good ones. Contribution terminations, withdrawals, significant investment changes. The simple things, someone gets a pay raise but doesn't adjust their contribution so they don't give themselves a retirement raise. Employers, on the other hand, are busy running their business. They're trying to take care of their customers and grow their business. They also do not have time to take direct responsibility for each employee's retirement readiness. Finally, and most importantly, the participants' time. The overwhelming majority of participants want someone to keep them on track and relieve them of the need to be a savings and investment expert. And yet, retirement savings is repeatedly the number one financial worry. Time and again, we hear that fewer than 10% of plan participants use the online tools that most providers make available to them. When you ask participants for a vision of their retirement, they don't talk bank balance. They talk about how they will spend their time. Working together, we can create the time to add the value. So we invented CoPilot. Remember this? This is the illustration from a few slides back. This is the participant journey. It includes the retirement goal, their retirement need, and all of the actions that they may take daily in their working life to make their retirement better or worse. CoPilot is our proprietary software and service for taking care of participants and working with them on their retirement journey so that they can take advantage of the Savers Credit if it's available to them, make the right Social Security election, and accumulate enough assets through their working lifetime to meet their retirement goal and the retirement goal that they should have. Let's take a minute to talk about retirement versus savings. Which of these is a retirement plan statement and which one's a liability magnet? If we look at the traditional 401k plan statement, it's going to look something like what you see here. Lots of data, lots of percentages, lots of balances, pie charts, all sorts of investment information that the average participant doesn't have the time or the desire to learn and to use. A retirement statement is a liability avoider. It helps provide the participant with a picture of where they're actually headed. In the CoPilot 401k service, you see a statement that looks like this, where the participant can see what their retirement balance should be in years and what their retirement balance will be at their current rate, also in years. We tend to recommend that people fund for 23 years of retirement, and then we work with them, starting with their existing contribution rates, to elevate them to the right rate. So a participant can't come back to you to say, I didn't have enough retirement. I didn't know how to apply all of that fund information to determine if I was going to be okay. Simply stating, this is how many years of retirement you're projected to have clears up that conversation quickly. Participant retirement conversations, accurate versus effective. Traditional participant retirement conversations include statements like, you have a balance of $41,000 in your 401k account, or your contribution rate will automatically escalate by 1% on January 1st, or you shouldn't split your balance among 3 target date funds, that's not how they work. Each of those 3 statements implies that you're watching out for this person's retirement or you know something about the condition of their retirement. In fact, none of those statements helps a participant to understand exactly how much retirement they have or don't have. If you contrast that with the CoPilot 401k service statements, those statements sound like, first, you're on track to fully fund 9 years of retirement. Want more? Click here. Or happy birthday, for $61 per paycheck, you can buy 2 more years of retirement. Click here. Last, your managed account will move from the growth account to the moderate account this year. Each of these are informative and, in cases where necessary, actionable pieces of information so that they can stay in touch with exactly how much retirement they have and don't have. That's a fiduciary outcome. In years of retirement, the participant communication becomes simple even at a transactional level. CoPilot Retirement Service makes retirement readiness understandable. That adds value and reduces risk. For example, a conversation with a participant could be, Bob, if we change nothing and today was your retirement day, you could afford to maintain your current lifestyle for 17 months. Then you'd have to rely entirely on Social Security, go back to work, or get help elsewhere. In our experience, that statement alone raises contributions more than 25%. When retirement is expressed in understandable terms, it's easier for participants to make better decisions. Mary, your requested hardship withdrawal will remove 4 years of retirement from your account. Can we find an alternative for the current need? Ted, stopping your contribution will remove 9 years of retirement at current assumptions. Can we find a way to keep those years in your future? Alice, it's too late to save enough for retirement, but there's a way we can coordinate your 401k and Social Security to potentially add hundreds of dollars to your monthly retirement security. Simply stated, by adding value, we remove mystery, and that removes risk. Now let's talk about how employer conversations have changed over the last 33 years. It used to be that a conversation with a plan sponsor was something like, your plan has $3 million in it, and 12 of the 15 funds in your plan are rated 4 stars or better. Then we moved on to 7 of the 10 target date funds in your plan are top rated. It's unfortunate for the people that are in the other 3 funds, and remember, ERISA requires that we take care of each employee, not employees generally. Then we moved on to your participation rate is 81%, which is in the top 20% for companies of your size. And then we got a little more specific. Your participation rate is 81%, which is in the top 50% for companies of your size in your industry. These are all wonderful general statements, none of which speaks to the individual preparedness of the people within the plan. And that's where the problem begins. When participants arrive at retirement with a retirement problem, those problems tend to be 6-figure problems. They don't tend to be small problems. They tend to be hundreds of thousands or multiple hundreds of $1,000 problems. And that gets expensive if it happens even once. So where are we headed? Now retirement conversations at the employer level are, Mr. Plan Sponsor or Mrs. Plan Sponsor, your employees, Bob, Mary, Ted, Alice, are headed off a cliff. The CoPilot version of that same conversation is, Mr. or Mrs. Plan Sponsor, Bob, Mary, Ted, and Alice are headed off a cliff. But you've got CoPilot, and we've got it handled. So let's talk about CoPilot. CoPilot is a fully bundled 401k service. It is not an annuity. It is not an investment product. CoPilot was invented in 2009. It's been on the market since 2012. It consists of managed model allocations with a named investment fiduciary. Managed model allocations include 5 target risk models. Participant communications are done on the basis of years of retirement. All of the examples that we just shared with you, those are the communications that we have with participants to support good decision making. Participant retirement service that starts with the saver credit and ends with Social Security reminders and elections. Proactive engagement, such as, happy birthday, buy yourself a year off, click here. Email and text-based messages where available. We have a licensed call center for participant support. We have a documented record of participant retirement decisions as well as fund decisions. For risk management, we have participant-level documentation. The managed model allocations can be commission-based. We have a level compensation commission models that include 25, 50, and 100 basis points. The service can be either fee or commission-based according to your firm's policies. For commission-based, level comp solutions such as Broadridge work best, and specifically some large firms have firm-specific portfolios. So the provider and the portfolios tend to be tied to your firm if you're one of the firms with over 5,000 advisors or representatives in it. More immediately, CoPilot addresses the SEC money market reform issues that are required to be addressed by October 15th of this year. CoPilot results in higher contributions due to a higher level of awareness by participants. And CoPilot includes automatic features, which means more time for more customers and a bigger practice. If CoPilot is providing all of those services, you may wonder, what is my role? In fact, your role is critical, and we'll demonstrate why. Your role is to educate, communicate, connect the service with the customer business plan, connect the service with the participant financial planning, and simply put, customers simply value the local presence and representation. CoPilot has been on the street with some major national banks and payroll companies for a few years now. When plan sponsors are given the choice between a model that includes local representation or a model that does not include local representation, they have consistently chosen to pay extra to have someone local to talk to. What's not my role? If you're working with your customers using CoPilot, you don't have to deal with issues like the SEC money market reform. You don't have to deal with fund closures. So keep in mind, under the fiduciary rules, if a fund closes and you choose not to replace it, that's a fiduciary act. The upcoming SEC swing pricing proposals that we'll be living with in the next year or so, you will not be reviewing 17 systems for participant behaviors. We'll reach out to you to let you know that things are being taken care of. And last but not least, you don't have to worry about the fact that you didn't know what you didn't know until you found out that you didn't know it, and then it comes with a price tag. Should I use CoPilot with my clients? Yes, if you have business clients you value, but you don't have time or desire to become a retirement income security specialist, you should use CoPilot. If you have a large retirement practice with hundreds or thousands of participants in many plans on a dozen platforms, upgrade to CoPilot, simplify, and add profit. If you don't want your customer to find someone else to take care of their largest financial investment account while you hope you can hang on to the rest of their business, you want to use CoPilot. Who shouldn't use CoPilot? If you know where each and every one of your participants is on their retirement income security journey, and you both have documented agreement, you and the participant, then you don't need CoPilot. The 338 example that we gave you earlier on, they thought that they were in good shape, and yet they ended up with a claim, and that was even before the fiduciary rule came out. If your customers have HR departments who have the time and expertise to know where each and every one of their participants is on their retirement income security journey, then you don't need CoPilot. We don't run into many of those. If your customers aren't logging into systems for products that you sold them or asking you for information, that's a sign of a bad day coming. Getting paid under the new fiduciary rules. In many cases, we need to coordinate the managed model allocations with your home office policies. Where we receive guidance from a home office, it will dictate the models available. Those models will affect form and amount of compensation. If you work for a firm with more than 5,000 reps or advisors, we are already working with your home office and waiting for their policy decisions. You and your clients will be contacted as soon as we are cleared for takeoff. Fee-based solutions are best as they allow freedom of movement for managed model allocations. Commission-based solutions are available for 25, 50, and 100 basis points. Please note there are a lot of 75 basis point plans around, but not a lot of 75 basis point commission funds around. It's best to move to another commission level or to go fee-based. CoPilot service pricing. The CoPilot fully bundled 401k plan has a monthly administration fee paid by the employer of $100. Notice it does not scale for the number of employees, it's a flat $100. There's a monthly record-keeping fee paid by the employee of $4. The CoPilot Fiduciary service, including the 338, is 25 basis points, and the PAI Trust Custodial and Trading Fee is 7 basis points. Current PAI plans pay a one-time fee of $250 to convert. Employers not currently with PAI pay an install fee of $390. And if they have an existing plan and it's under $250,000 in assets, we charge a conversion fee of $1,000. Existing plans over $250,000 in assets, the conversion fee is waived. In addition, we are seeing a lot of blocks of plans moving through banks, brokers exiting the business, CPAs exiting the business, others of that nature. If you bring in a block of 10 or more plans, custom pricing is available. How much should I charge? First and foremost, pay attention to your home office policies. Every day we are getting new policies from different firms. Some are going fee only. Some are going commission only and providing an asset list. Some are setting compensation rates according to plan size. For example, a rate for plans under $1 million, a rate for plans between $1 million and $3 million, a rate for plans over $3 million. You want to pay attention to your firm policies so that we stay in line there. Second, only you and the employer can determine how much you should charge. Some plans are more difficult than others. Are the employees in one location or many? Are the employees in an office with access to the internet, or are they out on job sites? How is employee engagement generally? Are there gaps to cover? In the simplest of terms, if you do a lot, charge a lot. If you do a little, charge a little. If you don't do anything, don't charge anything. For perspective, the United Kingdom has a national retirement savings program called Nest. The cost on that plan is 180 basis points on new deposits, 30 basis points on existing balances. All of that equates to about 50 basis points if the participant stays in the plan for 10 years. Provides no retirement CoPilot, it provides managed model allocations, and provides no local representatives. Everything is done online and through a call center. That may give you some perspective on what other charges look like. Finally, CoPilot is just the start. As huge as this change is, there's actually more good things coming. For example, tiered pricing, payment plans, and an upcoming autopilot for integrated payroll. And we also have a real game changer that you want to stay tuned for. More on that later. The morning after the night before. In our industry, there is a structure that we want to be careful of. And in order for you to make sure that you stay out of trouble in this regard, you want to make sure that you check your commission and fee statements. At PAI, we regularly hear of two structures that are risky. We hear of people doing split commissions, where you help get a case off the ground and someone else provides primary contact. We also hear of reps and advisors inheriting cases when another rep leaves the business. Under the new DOL fiduciary rule, there is no such thing as kind of fiduciary. If you are named on a case, or are collecting commissions or fees on a case, and you are not actively servicing that case, we highly suggest that you overtly engage in that case or overtly resign from that case. 401k hookups are deadly for you and your firm. On the more positive note, action for fun and profit. Plans already with PAI will receive an offer to convert to a CoPilot service well ahead of the fiduciary implementation date, April of 17. Support them in that choice. Bring your other plans with incomplete fiduciary solutions over to PAI and CoPilot. Contact your local banks and payroll companies. Many are exiting the business or they're looking for help. You can provide that help. We can work with you. Many reps and advisors are exiting the business. Offer to help. Some home offices are exiting the business. The rep across the street may work for one. Stay in touch, pay attention. There's a lot of this becoming available. If you bring in a block of plans, we may be able to offer discounts. Be patient and persistent. There's going to be a lot of movement in the next 12 months at the plan, advisor, and brand level. To get started today, contact the PAI team, 800-236-7400, ask for sales, or contact us at sales@pai.com, or go to our website at www.copilotretire.com. Thanks very much for joining us today. We look forward to working with you to increase customer satisfaction in the days to come and adjust your practice to make sure that you can grow and provide the service that you've been used to. Again, thanks very much for the opportunity to work with you. We look forward to hearing from you.